Okay, you guys are in for a big treat today. I noticed recently we've done a lot of episodes about being on the operational side of things. We've done a lot of things about economics, but we haven't done a ton about passive investing. And I was thinking, why not pull one out of the woodwork? And I actually reviewed and noticed that our first ever episode, which is one of my favorite episodes we've ever done, is an excellent way to do a throwback and also get some quality content. It's extremely dense. I hope you're ready for an hour and 7 minutes of awesomeness. I'm going to let the full intro play so you can get the full impact of what it was like during our first ever episode a few years ago. All right, hope you enjoy it. Welcome to the first ever episode of the Cash Flow Connections podcast. We started this podcast off with a bang with our guest, Jeremy Roll. Jeremy is an extremely experienced investor, and during this conversation, we discussed one of many things Jeremy is knowledgeable about, which is conducting due diligence on commercial real estate investments. In this episode, we discussed investing in multifamily apartments, self-storage facilities, retail shopping centers, and even mobile home parks. So, if you're interested in investing in any of these asset classes, I promise you're going to learn something new. I know I certainly did. So, here is the first ever episode of the Cash Flow Connections podcast. How's it going, everyone? Today, we have a very special, very knowledgeable guest that hopefully should set the tone for some of the content that we want to send to our listeners. Today, we have Jeremy Roll, who is an active investor who's been investing for about 14 years. He's currently invested in more than 70 opportunities, which have a combined asset value of about $500 million. He's the president of the Roll Investment Group, which helps more than 1,000 investors who are seeking passive investment opportunities. He's also the co-founder of a networking group called For Investors by Investors, which is a nonprofit that helps people learn from other investors and other like-minded individuals. They have more than 12 monthly chapters and 23,000 members. It's a really massive networking group that spans multiple different states. He's the advisor for a company called Realty Mogul, which is one of the largest online real estate crowdfunding platforms in the US. And he also has a MBA from the Wharton School. So quite an impressive background, quite an impressive resume. Jeremy, I know that you're very busy right now, but I really appreciate you taking the time to come on the program today.
Oh, no problem. Thanks very much for having me. I'm particularly honored to be your first guest, so thanks for having me. I appreciate it.
Absolutely. So tell us a little bit more about your background and how you got started investing in these passive commercial syndications. Sure.
So my story is actually probably relatable to others who are listening. So way back in 2001, 2002, we had the dot-com crash, which was basically a very large stock market crash for those of you who are a little younger, where we had a dot-com boom from all the online companies coming on, and valuations got very high in the stock market. And so then we had a stock market crash. And at the time, I was actually working in the corporate world. I was actually kind of a middle-level manager in marketing at Disney headquarters in California. And I had all my money invested, like a lot of people in the corporate world, in basically stocks and bonds in a Disney Fidelity 401k program. And what really bothered me is that I had a lot of this money in the stock market that went up and down, and it was very volatile. And frankly, there were two things that bothered me about the way that I was invested at the time. One is the volatility. I'm a really low-risk, slow and steady guy, so to watch the market go up and down 30% in a year is just not for me. The biggest problem, though, that I really had, and the biggest concern, was that there was a lack of predictability. So, as everybody probably knows, when you invest in the stock market, there's obviously a lot of great things about the stock market, many great things, but one of the challenges is that there's a lot of lack of predictability. So to know where your retirement's going to be, account is going to be, if it's mostly invested in the stock market, in a year, 5 years, 10 years, 20 years, is really unknown. And what I would call a roll of dice. You can make some assumptions on an average annual return, but it just changes every day. So what I was really looking for after the dot-com crash was a lot more predictability. And so I started basically dabbling into the passive commercial real estate opportunities, syndications back in 2002, and then started to learn more about how they work and the various asset classes. And long story short is I had rotated all of my money from stocks and bonds into passive cash flow. A lot of it was commercial real estate, but there was some other stuff too, even non-real estate at the beginning and even now. And that's how I got down the cash flow path. And, bottom line is that it's been about 15 years that I've been investing like this now. And cash flow has completely changed my life. So if anything, I'm very grateful for the dot-com crash because it really put me on a different and what I consider to be a much better path for myself. So,
sure. So a lot of people, when they get started investing in real estate, a lot of them focus on single family because that's typically what they're most familiar with. It sounds like you were immediately drawn to commercial. Why is that you were drawn to those type of assets?
Yeah, that's a great question. I think the biggest draw for commercial with me was actually the diversification. And so the fact that you could be diversified across tenants was really, really key. So, for example, there's a lot of investors I know who invest in individual homes, single family homes, and they have to put a lot of money towards to actually purchase each home. And so maybe they'll buy 5, 10, and on a really good day, 20. Obviously, there's much bigger investors than that. But, if someone's got a 20 single family home portfolio, it's a pretty good size. The challenge that I see in that is that, for each home, there's one tenant, right? So either you're 100% occupied or you're 0% occupied, putting aside, carving into two, or maybe you're renting to multiple tenants. So let's just keep it simple. Where I really like commercial real estate is I can actually, with even less money that I have to put in to buy one single family home, I could potentially invest in a 200 or 300 unit building in some areas in the U.S. where there's 200 or 300 tenants. Perhaps it's 100% occupied. And so, for my low risk profile, if one tenant vacates, then your occupancy rate goes from 100% to 99% or 99.3% or whatever it is. So the tenant diversification is a really big deal to me. And that's what attracted me the most to commercial real estate. What I also like about commercial real estate, though, is that a lot of it's valued based on a business angle. And so for someone like me with a bit of a numbers background, it's definitely, I wouldn't say easy to understand, but I was definitely able to get my arms around it. And I just love the fact that because it's looked upon as a business, I can really focus on the cash flow aspect, and it's typically valued often on a cash flow aspect. So that's the kind of thing that I was looking for. And I got really lucky, honestly, too, because there were lifelong friends of my family in Canada who had been working on commercial real estate opportunities for decades with investors at that point. And when I first started investing in 2002, I had moved down from Montreal in 1998 to Philadelphia in 2000 and to LA in 2002. And I didn't quite know who to trust in LA as well as in the US in general, meaning I was very new to this country and new to that city. And so having that person that I can actually make a bet on to begin with in a passive way that I actually knew for a long time was really a huge advantage. It would also help me to learn how commercial real estate works. So it was more, I wouldn't call it a mentor situation, but certainly, reduced my risk by knowing who I was investing with to start. That was a really good place to start.
Absolutely. Absolutely. So before we jump into the meat and bones of this conversation, which is going to be about commercial real estate due diligence, I have to ask the question that you probably get very frequently, which is in the bio, it mentioned a full-time passive investor. So I think there's probably a lot of misconceptions about what you do on a day-to-day basis. I think maybe some people think that you're sitting by the pool a lot of days, drinking margaritas and stuff like that. So let's kind of outline how you turned being a passive investor into a full-time career.
Yeah, and it's funny. It's a good point you make, Hunter, because I do agree. Like, I can see why somebody would think that being passive, for someone like me means that I'm doing nothing all day. And in fact, I had a lunch meeting today with somebody and explained to them that I actually work all day and I work at night. And so I actually work more hours now than I did in the corporate world, and I'm a passive cash flow investor. So essentially, the reason why it's so much work is because if you want to get properly diversified and find a lot of opportunities to spread all your risk, it's very hard to find these opportunities. These opportunities, for the most part, are privately marketed. They're not allowed to be publicly marketed due to public solicitation laws by the SEC and FINRA. And so you have to create a network to find these opportunities. Now, I would say the one exception to that, which was not at all available when I started, is the crowdfunding site that some people might be familiar with, including Realty Mogul, who I'm an advisor for, and there's some other really great ones out there as well. And the benefit of those platforms is that you can join them, and once you're joined into that private network, you can log in and look at opportunities and get access to opportunities immediately. They, in turn, typically take some type of a fee in exchange for both finding the opportunities and managing the opportunities going forward. So your returns are a little lower, but they're offering a great service by actually providing people with access to these opportunities. Now, I've spent many, many years doing a lot of networking to find the opportunities because crowdfunding wasn't available. And I continue to go down that networking path because for me, because I've built a network, I'm able to find the opportunities directly and get a little bit of a higher return because I don't have, intermediary taking a bit of a fee for finding the opportunity. And I've just chosen to continue to go down that path because I have the full-time, work week to be able to do it. So a lot of my time is spent trying to find opportunities, networking to try to find opportunities. And when I say networking, I mean going to networking events, talking to other fellow investors like you, Hunter, and actually looking at opportunities and really actually doing due diligence on them and vetting them out, and talking to new potential operators or sponsors who may have opportunities in the future. And so when you start to add everything up, along the fact that I built up a private investor group as well, that takes some time to manage, I end up being extremely busy and nothing at all of what someone out there might be picturing.
Right. Yeah. So if you're not familiar with Jeremy, you know that his time is allocated in 30-minute blocks. Every single minute is usually allocated on a weekly basis. So one of the things you mentioned there is conducting due diligence. And that's what this conversation is going to mostly be about. So when you start to look at an opportunity, or if you're conducting due diligence overall, what are the most important aspects you look at? Is it the sponsor, the market, the legal documents, or what are the first things you focus on?
Yeah, so that's a great question. And so I want everyone who's listening to keep in mind that I'm answering from the perspective of a passive cash flow investor. And what I mean by passive is that I'm investing in a syndication or an opportunity that's been where they're pooling a lot of investors together. Someone's pooling a lot of investors together, taking those investment funds, and then making the day-to-day decision on behalf of the investors, meaning that I may have a very small percentage ownership of a much bigger deal. And because of that, my vote is a very small percentage vote of the entire vote of everybody for major decisions. And therefore, I am essentially giving control to somebody else who is an expert in an asset class to be able to run that deal on my behalf. So what I tell people is that as a passive investor, I trade control for diversification, meaning that instead of putting a lot more money into a single family home and owning that home directly and owning the title to that home, I will put maybe a smaller chunk into a office building, and another smaller chunk into a self-storage deal, another one into a mobile home park. But I'm giving up control each time in exchange for the diversification. The great news, though, in giving up control is that theoretically you're actually giving control to somebody else who's an expert in the asset class, and knows like 30,000 times more about the asset class and how to run it than you would potentially. So that's what we're discussing today, because that's the type of investing that I do. And so when you think of it from that perspective, I always tell people that the number one thing to consider as far as due diligence of being a passive investor is you're really trying to assess who you're making a bet on. And in other words, who are the managers of the opportunity? Are you making a bet on good people or bad people? Are you making a bet on people who really know what they're doing? Are you making a bet on people who are going to be fraudulent or not? Are you making a bet on people who are trying to be conservative in their projections and perhaps purposely to be able to overperform for investors and create long-term relations with them? Or are you looking at people that are being aggressive, trying to make numbers look really good to attract investors, possibly with knowing that their odds of them hitting the numbers are not very good, and they're just trying to get the deal done to make their fees and then move on to the next, and they don't really care if you join in a second time as an investor. They're just going to find some more investors. So the most important thing is, who are you making the bet on? And actually, I would argue that in many ways that's even more important than what is the actual investment, the actual asset itself, be it the location, the type of building, when it was built, tenant base, and all the other factors. I think who you're making a bet on it is the most important thing. And one example I like to actually give is, I live in Los Angeles, and most people listening probably have heard of Rodeo Drive, Beverly Hills, very famous street, very high-end shopping. And what I like to tell people is, you can invest in the best building in the middle of Rodeo Drive that's 100% occupied, but if the person you invested with runs the building to the ground, mismanages it, commits fraud, or does other things, then ultimately what's going to happen is that, people are either going to move out, there's going to be a revenue problem, and it's ultimately going to get foreclosed. And then it didn't matter that you invested in the best building in Beverly Hills or on Rodeo Drive because you had the wrong manager. So that's why I like to say that if assessing the manager is the most important thing as step one, and then assessing the asset is then the most important thing as step two.
Perfect. Yeah, that makes total sense, especially since you are investing in passive investments exclusively. The person who you're making the bet on is the most important. And you're just, when it comes to due diligence on specific sponsors, a lot of that due diligence has to do with deciding if this person is the type of person you want to make a bet on. So I want to ask a couple of questions about how you do that. So what are some of the steps you take to see, is this person making conservative assumptions or are they making aggressive assumptions? What are some of the steps you take to verify those?
Yeah, great question. So there's two different ways, just high level, that you can get to the bottom of that. And so, or at least two, there's probably more than two ways, but the two ways that come to mind for me right away are A, looking at their projected numbers, so their spreadsheet or projections, and understanding the assumptions behind those projections and whether those appear to be conservative or not. Now, I'll give you a great example. And by the way, what's important to consider is that depending on the assumptions you make, people can purposely make numbers look better than they are or not, right? And be conservative or aggressive. So some really good examples are, let's say you're investing in an apartment building and they're assuming that the average rents are going to increase 3% a year, okay? And they say that that's keeping up with inflation, okay? But then you take a look at expenses and they're only going up 1% per year, as an example, okay? And they say, well, that's also meant to keep up with inflation. So how is it possible that if someone who's trying to match the numbers to keep up with inflation is assuming revenues are going up 3% per year, but expenses are only going up 1% per year? To me, that's already a yellow flag and possibly even a red flag, actually, with that kind of a spread that tells me that either this person is assuming that their apartment building is in such a strong location that the inflation for revenue is going to way outpace the general inflation at 1%, or they're purposely understating the expense inflation to 1% instead of being the same as revenue. They should be equal or at least close to equal because they're creating a gap in the additional total profit that's going to come each year that tends to compound. And so, they may be doing it to make the numbers look better and to make the ultimate value at the end of the term look better for the property. So there are certain assumptions you have to look at, and each asset class is different to understand if somebody's being aggressive or not. And as you start to learn the asset classes, you kind of know what to look for. And I can give you all kinds of examples, but I'm trying to keep it simple for today's purposes. So that's one thing you can do, right? You can look at your projections and assumptions and understand if, start to really nail down, is this person being aggressive or not, or conservative? On the flip side, I think what a lot of people don't necessarily consider that I'm very specific to do is to both read the overview very carefully, literally word for word, and try to understand if there's any hint in the way that the overview was written for the opportunity as to whether someone's a conservative or aggressive. And what I mean by that is sometimes I'll actually see an operator specifically say, if they talk about market rent, for example, in a section, it will say, current market rents are X% below, current rents of this property are X% below market rent. In an effort to be conservative, we've kept them at that level, but we believe that it's possible that, we may do better than that or something of that sort. I'm obviously using the wrong verbiage, but you get the point. And so,
Totally.
The point is reading that starts to actually tell you who you're dealing with. Like, it actually starts to give you a read on who are these managers and what is their personality, and is it the kind of person I want to make a bet on or not, right? That's actually a good indicator, right? Whereas the opposite type of thing, reading it, where someone seems like they're being very aggressive or making a very, using the word guarantee, which is usually a red flag, or using words that just seem like they're trying to make the property sound like the best thing ever, and it's in the strongest location ever, and, certain words will tell you who you're dealing with, and then whether or not those are green flags or red flags, so to speak. And equally as important, and I call these like intangible things to look for, right? Equally as important is I would strongly recommend that at the very least, anyone who's looking at an overview have a phone call with the operator. I actually almost always, and probably always, meet with the operator in person at least once before I invest with them. And I try to do that because there's never a better indicator than getting a gut feel for somebody in person in terms of how they're answering, looking in their eyes, and really assessing whether you believe what they're saying, et cetera. But even over the phone, if you have, let's say, 10, 20 questions for somebody about an opportunity after reading their overview, you want to gauge how are they answering those questions. So let's say you couldn't quite figure out if somebody's conservative enough by reading over you. Let's say it was very neutral. But then you get on the phone with them and ask them about the location and ask them what they think about the rents in the surrounding areas and ask them about what they think about the future for the property. The way that they respond will give you, again, an indicator of who you're dealing with. And those are also intangible indicators, but very important ones. So you got to read between the lines is what I guess I'm trying to say. And there's just different ways you can do it. That's a very important aspect too, that, combine reading between the lines with the actual looking at the real data and the numbers, and you kind of start to get the full picture of who you're dealing with.
Yeah, I think that's great advice. I think that one of the things comes to mind. I saw a deal recently where the operator was anticipating a refinance every single 12 months. And because they were anticipating that refinance every 12 months, they were projecting investors to return capital back every single time there was a refinance and be completely out of the deal within 4 years. So if you're reading that, it could happen, right? It could happen. But the fact that the operator is setting the investors up to expect that is very much a red flag. Like, it's the kind of thing where you wouldn't need to look much more into that executive summary to understand that they're being very aggressive in their projections. So yeah, I think that's a great point. In terms of the market itself, what do you look for when doing due diligence on a market? Are there certain markets that you're focusing on? Are there certain markets that you're interested in? And what makes those desirable?
Great question. And, that it's a very hard question to answer because it's going to depend on the asset class. So let me give you a great example, right? If you're looking at assisted living facilities or independent living facilities, which are basically retirement homes where there's certain different levels of services that are provided, et cetera, they're typically almost like apartment communities, but as retirement homes. And so if you're looking at that market, when you're analyzing the market for that, there's a lot of factors in play. What's the current median income there? Are you expecting to be all cash pay, or are you actually expecting that you're going to get mostly reimbursed by Medicare, for example? The traffic counts, for example, on the streets that you're on are probably a lot less important than if you're trying to invest in a retail strip center that has storefronts that are dependent on people driving by and actually stopping in and seeing the visibility. And so from a market perspective and from an exact location perspective, it's really going to depend on the asset class. And by the way, just going back to the retirement community, you have to look at the supply of what's available surrounding you, and is that market saturated or not? That might be much harder to determine than if you're looking at a retail strip center in a specific area, let's say in a suburb, where you already know that because of the way the suburb was constructed, perhaps it's a main street with a whole bunch of large shopping centers surrounded by housing. And then there's actually a limited supply of those retail strip centers. And if you're going to invest in one, you're in a great position because you've actually got a limited supply situation where there's no more land and no more zoning for more strip centers to be built. Whereas with a retirement community, it's probably much easier for someone to come in and build or repurpose an existing apartment, for example, into that. And so there's a lot of different considerations depending on the asset class as to what market makes the most sense. And so I could probably give you more examples depending on the asset class, and I hope that makes sense, but it's a really tough question to answer overall. I will say this, obviously, wherever you are, you're going to want to make sure there has been strong demand, there's projected to be strong demand. Typically, it's better to have population growth in a growing area than an area that's in decline. That could cause all kinds of challenges. Looking at median household income, depending on the asset class you're looking at, could be very important. Really depends on the asset class, but understanding if you're trying to, so if you're concerned about a recession, for example, and you're concerned about the middle class as far as their viability of income going forward, you're going to want to stay away from an area where the median household income is all middle class, and that could erode within the next 5 to 10 years. And so if you're trying to serve, if you're going to offer a specific asset class that's meant to target lower income population, like a mobile home park, then probably that's not going to make sense to have in the middle of a high-end affluent area, right? And so it's hard to answer that market question because it's really going to depend on the asset class. But I don't know if you have any specific questions for me on it. I hope I kind of answered and made sense in the way that I answered.
No, yeah, I think that makes total sense. So you mentioned the mobile home parks. When you talk about mobile home parks, is there anything that you look for in terms of a discrepancy between the nearby single family houses and the affordable housing like mobile home parks or manufactured homes?
Yeah, great question. So, I do not proclaim to be a mobile home park expert. I know a decent amount. I've invested in many different funds related to mobile home parks, and I've been through a couple of courses. But my understanding is that, I've invested with who is now the fifth largest owner of mobile home parks in the U.S., and I've learned just a tremendous amount from them. And one thing that I can tell you is that the key metric that they look at is that they compare the two things. They compare the lot rents in their parks to the cost of a B-class apartment community, and they want to look for a specific minimum spread between the lot cost, the lot rent, and the cost of that B-class apartment, because they believe that if there's enough of a spread that somebody who has a choice to either be in a mid-range apartment versus owning their own home outright, that is very attractive if the spread is large enough. So that's what they look for specifically. But you also, at the same time, want to look at the lot rents compared to the lot rents in the immediate competitive parks near you, so you can understand whether you're currently commanding a premium or whether perhaps you're currently in a market rent and have the ability to still bring it up and yet have that spread between, let's say, where you are today and the market rate, and then the market rate having a nice spread between the lot rent for the market rate and the actual Class B apartment in the area. So that's typically an indicator that, if I was doing due diligence on a mobile home park, you probably want to look at.
Makes total sense. And so I just a follow-up question to that. So when you receive these statements from the sponsor saying we have this discrepancy in the B-class apartments with the nearby mobile home parks, do you then try to validate those claims somehow? And how do you validate the claims in terms of those discrepancies?
Yeah, so great question. So I would say it depends, right? So it depends on A, whether you've already invested with someone before, B, how much experience that operator has, and C, how confident you are in having them do the due diligence. So I want to make it clear that when you're making a bet on an operator, you're basically making a bet on the entire skill set that they have. And part of that skill set is their ability to evaluate the market and ensure that they're actually making a good choice as to where they're acquiring something. And so what I would tell you is that the approach that I typically take is actually, especially at the beginning with a new sponsor, is your job as an investor isn't necessarily to do all of the diligence that they would do, because A, you're not going to be expert enough to be able to do it. B, you may not have the time to do it, okay, even if you were expert enough to do it. I would say your job more so is to evaluate whether they've done a properly detailed job of looking at all the angles and all the potential risks and assessing them, and whether they've done a really good job of determining in the end of the day whether or not this property makes sense. So, I don't think that people necessarily need to go to the extent of validating every single number that they're presented. There's always going to be a fraud risk no matter which way you look at it. But I think it's very important that the logic that the operator used, you're able to validate and get very comfortable with, and you actually agree with, and it actually looks right. What I would say also, Hunter, is that if, let's say in the scenario you're proposing, when you start starting to work with a sponsor, you can absolutely go on to many different sites, apartments.com, many different places, and actually price out what appears to be, a B-class apartment in the surrounding area. And you'll very quickly, thanks to the internet, you can very quickly assess whether or not they, at least with the numbers they presented, appear to be in the ballpark and correct. But I'm actually more concerned as an investor as to whether the sponsor was thorough in looking at all the different attributes they should have looked at, and whether their conclusions look right. And frankly, even like, did their calculations actually add up correctly? Meaning, do I find any errors in what they had analyzed, and do I find any errors on their spreadsheets and on what they're doing and the assumptions they're making, as opposed to trying to figure out whether they use the correct apartment numbers? Because you'll find that if you're making a bet on an experienced operator, 99% of the time they will have used the correct data set. It's more a question where they analyzed everything at all the right angles to stay away from the pitfalls that you're most concerned about, because you're going to make a bet on them going forward for everything else as well.
Very interesting. I think that's a great answer to that question, especially given your position as a passive investor. It makes total sense. Okay, let's talk a little bit about the property itself. And this is certainly going to be asset class dependent, so I'll let you explain the four major ones we're talking about today. multifamily, mobile home parks, self-storage, and retail. When you look at a deal that is in one of those asset classes, what are the major things you're looking at when doing due diligence on the property itself? Let's start with multifamily.
Okay. When you say on the property, you don't necessarily mean the actual physical structure. You mean just looking at an opportunity in that asset class, correct?
Yes.
Okay, great. Okay, so I'm going to assume that in general that we all understand for the purposes of this conversation that, of course, the location is very important, because there's some obvious things that are important, right? So like the year something was built, et cetera. But I'll point out the real things that are standing out as opposed to everything, I think. So with apartments, one thing that's really, really critical, depending on where you are, and I'm going to use Texas as an example. A lot of people like to invest in Texas apartments. And, apartments have actually changed in their configuration or how they've been made. In other words, appealing to what the needs are of the current population over time. So one thing, for example, that I like to stay away from is apartments dating before 1980 in Texas, because those tend to be more C-class apartments. And the reason why they're C-class apartments is because their structures and the way they were built are a little bit older and are less desirable right now. Whereas the layout, both not just the apartments themselves, but even the grounds and the surrounding layout of a B-class apartment that's 1980 or newer tends to still be a little bit more modern, hasn't changed as much, and therefore would probably be more appealing to the average renter and will hold its value better going forward at the moment. So that's the key point that I look at in apartments. That's kind of like number one. And then obviously you're going to want to see if the structure that you're looking at conforms to the immediate surrounding area. So again, in Texas, you're going to find a lot of garden-style apartments. And what that means is that they're kind of spread out amongst many different buildings, typically 2 stories. So if you find an apartment building in Dallas that's a 30-story apartment building, you got to take a step back and wonder, okay, is this what the population in the area wants? Do they want to have that 30-story apartment building like you might find in downtown Los Angeles, where there may be no grounds for them to walk around? Or do they want sprawling, multiple acre with a pool and other amenities? Is that what they're going to look for? And so is that, high-rise apartment in Texas going to have a problem attracting tenants? And are you going to have a challenge selling it? Because other buyers are going to look at it the same way. So that's also an important thing to look at with apartments. One more thing that definitely comes to mind that's important is the expense ratio. And what I mean by that is, in the assumptions in the pro forma, aside from the general assumptions of revenue and expense inflation I mentioned before, very important to understand on the total revenue earned, what percentage expenses actually trickle down to the bottom line. I didn't say that very well, but what I'm trying to say is that if you're earning $1 in revenues and there's 50 cents in expenses, your expense ratio is 50%. Okay, and so what you want to do, just at a quick glance, is determine the expense ratio that the operator assumed in their projection to make sure it's pretty much in line with the apartments of that type in that area. And when I say in that area, what I mean is that if you're looking at the apartments in the Northeast with brutal climate, cold weather, etc., and especially if some of those apartments involve utilities that are actually paid for by the landlord in common areas and other things, the expense ratio should be higher because you're paying for heating in the winter, etc. If you're in a more temperate climate in other places, let's say in LA, where there isn't as much of utility concern, potentially the expense ratio could be lower. And so you want to make sure that the expense ratio falls in line correctly. And because sometimes they'll actually use an expense ratio that's too low. So they assume expenses that are too low just to make the deal look good so that the actual profitability looks higher. And they're just making the numbers look better than they'll really be, right? Because they can assume any expenses they want on a piece of paper, but there's going to be actual expenses in reality they're going to have to pay. So you're going to want to validate that for sure. So that's kind of the gist of it for apartments, the ones that are quickly coming to mind. Let's see. For retail strip centers, that was one of them, correct?
Absolutely.
Some of the most important things for retail strip centers are specific location, is both in terms of traffic and visibility. You're going to normally want a retail strip center that's easy to access directly off a road with multiple access points, preferably people will be able to drive in multiple locations, as well as very good visibility right on the frontage of wherever people are driving by. You're going to look at traffic count. So for retail strip centers, it's important to understand if you're going to be in a big city or a small city, what the traffic counts are. And obviously, typically, a more traffic road is going to lead to more business, and it's going to be more helpful for retailers, and it's going to command a higher per square foot price. The traffic counts are really critical to assess. And for retail strip centers, absolutely critical is assessing the surrounding population's makeup or demographics, especially household income, in relation to the services that are being offered in a strip center, and are they aligned? So, really great example. Let's say that you have a strip center in Beverly Hills, okay, and you're catering to a very high-end population. Does it make sense to have a 99-cent store in that strip center? Now, some people argue potentially, yes, there are some high-end people who shop at those places, but on average, I'm just giving you the general concept that that may not be as good of a tenant as perhaps a high-end restaurant or some other thing that caters to a higher-end population, just as an example. Some other things that are coming to mind for retail strip centers, very, very important. Some of you may not know that when you take in a new tenant into a retail strip center, sometimes the landlord has to pay for all or some of the, what they call tenant improvement costs to get the space made ready for that tenant, right? So, if you had a certain type of store in a space before, let's say there was a gym in an occupied space, and now, next thing you know, a restaurant wants to come in. Clearly, a restaurant can't take a blank space that the gym was sitting in and just use it. They're going to have to put in kitchen equipment, cooking equipment. They're going to have certain walls to hide where the kitchen is. So there's going to be some costs associated with actually bringing that tenant in. You want to make sure that the operator you're working with has reserved enough tenant improvements, or assume they're going to have spend enough money on tenant improvements so that they're properly thinking in advance of what those improvements are going to cost. And as opposed to not thought about it, not included those reserves up front, and then all of a sudden, if you have a tenant that actually leaves and another one comes in, you're taking all your money from cash flow, or a good chunk of cash flow, and putting it towards tenant improvements, and now you're not actually getting the cash flow return you thought. So that's a very important point in retail strip center type of investing. Final one for retail strip centers is probably one of the most important ones is the future. So if you look at a Best Buy, for example, Best Buy it has been eroded very much so in its sales by the internet, the Amazons of the world, and that's a challenge. You have to be able to predict going forward where general consumer trends are headed, and whether your tenant mix is appropriate for what might be coming up in the future. So I always say that there are certain services that are being provided that people are probably going to continue to demand. So let's say fast food drive-through while people are driving. You can even argue that with self-driving cars down the road, perhaps the meal will automatically come to you. And is that going to make sense? I'm making this up, but I'm just trying to get people to think about certain things. But I would argue that if you have a store in a retail strip center that's selling products you can easily buy on Amazon, and maybe other internet retailers are popping up for it, is that store going to be in demand in 5 or 10 years because it's selling products that you easily sold online? You really need to think about the tenant mix now more than ever before, and try to project whether people will still demand those types of services 10 years from now. A great example is a nail salon, right? And except for maybe someone coming to your house to do it, women are going to have to go to a nail salon to get it done in person, right? I just don't see how that can be replaced in the short term. So that's probably going to be there for a long term, as long as women want to actually have work done to their nails, just for example. So you really want to think about that on the retail strip center work, just to make sure that you're not taking over a tenant that may not want to be there in 5 or 10 years from now. So the third asset class that you mentioned was self-storage. So
you know what? Actually, before we go on to self-storage, I definitely want to talk about it, but there's a couple of metrics in there I want to get your perspective on. So you mentioned traffic per day. What do you typically like to see in terms of traffic count per day for retail centers?
Yeah, so it's really going to depend on the area and the type of location you're in. So if you're in a smaller town, and let's say you're in a small suburb, but you're the main street in a small suburb, you may see a traffic count of 20, 30,000 cars a day if you're on the main street, okay? That might be common. But if you're in a larger town, like Phoenix, for example, and you're at the corner of Main and Main, so to speak, you may see traffic counts of 75 to 100,000 cars, especially between the two streets converging. So
Right.
it really depends on where you are. I would say that I get very uncomfortable with traffic counts below 20, 25,000, even in a small area, because it starts to get to the point where you wonder whether there'll be enough people driving by to actually. And by the way, in these discussions, I'm not referring to a retail show center has 2 or 3 tenants. I typically try to invest them and have 10, maybe 13 or more tenants for tenant diversification. And of course,
Totally.
the more tenants you have, the more traffic you're really going to need to be able to fill demand for those tenants.
Makes total sense. Okay, cool. Let's talk about self-storage. What are some of the things you look for that asset class?
Yeah, so self-storage, number one thing that comes to mind is definitely analyzing the amount of self-storage units available in that maybe 1 or 3 or 5 mile radius of people, pertaining to that specific location, versus the demand from the household surrounding that location, which can be run by the operator. You can get that information. And so what's really critical is that you want to be in a location where there's a lot more demand than supply for storage units, and particularly because the building cost of a storage unit is actually not very large. It's typically like kind of a shell, and there's not much to it. And so the barriers to entry in self-storage are a little lower because the cost to build is lower. So you do not want to be in a position where supply equals demand, or maybe supply is actually higher than demand, because obviously that's going to make it much harder for you to keep your units filled up. You want to have a nice gap that even if you have a couple new competitors come into the market, arguably because it's cheap to come into the market, from a barrier perspective, that there's still plenty of room for everybody. That's the number one concern in self-storage. Another concern in self-storage when you're looking at the projections is understanding the economic occupancy versus the actual occupancy that's in the projection. And what I mean by that is there's a lot of factors that come into play. You probably noticed if you ever use a self-storage unit that sometimes they give away a month for free or 2 months for free or some other type things. They may throw in a free lock, whatever it is. So that actually starts to detract from the potential revenue versus the potential vacancy versus the economic vacancy. And so meaning that once you start to factor in these additional concessions and promotions, the effective vacancy rate is actually, so to speak, higher. And that's a very important thing to take a step and to understand what the gap is. So obviously, the economic occupancy is, as it goes down, it means that there's actually more and more concessions and promotions that have to be given. And the more of a gap that there is, the more conservative, potentially, the operator has been in assuming how many concessions and promotions need to be given out to actually bring consumers in. Another thing that's a little complicated in self-storage, but it falls under a similar situation, is self-storage is really interesting because there's dynamic pricing on the more sophisticated operators. And what I mean by that is very similar to an airline flight. So if you're United Airlines and you have a 737 airplane and you're flying to a certain location tomorrow and the airplane's empty and you haven't sold a seat, presumably you have that fixed cost of actually having the plane take off, fuel, land. Let's say that flight's going. Presumably you're going to bring your prices down to fill up every seat you can because you have that automatic fixed cost no matter what, right? So it's going to be much cheaper for me to buy a seat on that flight a day before if the flight's completely empty, presumably, all right? In self-storage, it's somewhat similar, right? Because if you have, let's say that in self-storage, there's a large unit and there's a smaller unit. And for that population mix, for whatever reason, the smaller unit is much greater demand than the large unit. A sophisticated self-storage operator may say, okay, I've got one small unit left, but 10 large units left. I'm going to price the large unit even cheaper than the small unit, even though that doesn't sound to make sense. It's just because they want to move the large units, right? They want to incentivize people to actually go into those units. The problem with that is that you're giving up potential revenue. So again, it's that whole economic occupancy perspective, right? So it's important to understand the unit mix and how the operators account for that in the pro forma and whether they take into account those types of discrepancies into the economic occupancy that I'm talking about. And I'm sorry, I know it sounds a little complicated, but it's a very important point. Another thing with self-storage is that there's a surprising amount of self-storage traffic in a lot of areas, depending on the location, and typically occurs by drive-by traffic. So advertising is obviously an important industry, and a brand is important in the industry, but drive-by traffic is very important. So you definitely want to assess the location and the traffic counts immediately in front of the property, as well as the visibility of the property, to the surrounding areas. If you have a property in self-storage that's maybe just off of a highway, which would seem to be fantastic because there's a ton of traffic, but if that traffic the highway traffic can't see the self-storage property because it's behind a bunch of trees just off the highway, then the visibility is, let's say, 0, even though the traffic count was a 10, and you're not going to have the same positive effect of the traffic count on the location. So those are some of the immediate things to me coming to mind on the self-storage side.
Awesome. And we already talked briefly about mobile home parks. Is there anything that you wanted to add other than the discrepancy between the B-class apartments and the nearby mobile home lots?
Yeah, I definitely want to add 2 very important things when you're considering a mobile home park. The first, and probably most important, is when you think about a mobile home community, there are some that have a lot of renters and there are some that have a lot of owners. And obviously there's some that are mixed. So let's take a look at those 2 divergent scenarios. So in the case where there's a lot of renters, there's definitely a higher probability to have tenant problems because people are more transient. Obviously, you're dealing with a lower income population. So transient lower income population can potentially lead to more challenges. Whereas if you're dealing with if you actually are dealing with a high percentage of owners, then you'll find that, even though if you're listening and you have a stigma about mobile home communities, I can understand that, but you'd be surprised if you've never been to one that there's a lot of private ownership by the homeowners. These are homeowners, right? They're homeowners. And so if you have a very high percentage of homeowners in the community, there tends to be less challenges, less tenant problems, more people actually tend to take more pride in the community they have. They might plant more flowers. Things might be kept up better. They may mow the lawn more readily, right? So they're not tenants, they're owners. And so one thing I definitely always look for is a mobile home park opportunity where the owner's percentage is very high, if not 100%. Now, finding 100% is actually very hard, but a very high ownership percentage is very, very important. I personally stay away from anything that has a mixed tenancy or a high percentage of renters. The other thing I would say with mobile home parks is that you want to definitely invest with an experienced operator because you definitely have to know what you're doing in this space, both to manage the tenants, to manage rent collection, and even in the due diligence, you really need to know what you're doing. And I won't get into the specifics, but understanding the type of electric infrastructure you have, water, sewer, all these things, they could be very old. Some of them are owned by the city, some of them aren't owned by the city. And if they aren't owned by the city, if you don't have an operator that's sophisticated enough to properly assess the remaining life expectancy of some of these systems and really look at it and make sure that they weren't potentially in for a huge expense that they weren't expecting. So, I know, for example, sewage systems in some of these communities, if you didn't plan correctly for them, one of them breaks and has to be replaced. It's extremely expensive and it's just really, really, it can take the entire opportunity down depending on the size of the park. So you want to have operators who are experienced enough to understand the infrastructure aspect and to evaluate it properly.
Yeah, I think that's a great point. I think that asset class in particular, there are so many potholes of that asset class because of the tenant base itself. I think that some operators may make it a little bit more difficult than it needs to be. A great example is what you just mentioned, buying properties that their water is not controlled by the city is one of those ways. Septic tanks explode. Hundreds of thousands of dollars can be spent trying to fix problems like that. And another one is buying extremely heavy repositioned parks that are 20% occupied that require a ton of capital expenditure. Mobile home parks can be a great investment, but if you try to do those very aggressive value add components, it can be very expensive if you don't know what you're doing. So I think that's a great point in terms of investing in an operator that's extremely experienced. There's no reason to make that more difficult than it needs to be. So I don't want to take too much of your time. So I want to skip over underwriting. I know that sounds ridiculous. We did mention some of the stuff about expense ratios and something like that. I think I may have to have you on later to have a whole episode dedicated just to underwriting. But before I let you go, we definitely want to talk about legal documents. That is something I'm really interested to get your perspective on. What are some of the clauses? What are some of the things you look for in legal documents when reviewing to try to make sure that your expectations are aligned with the legal documents and try to validate that the operator has not misled you in some way?
Great question. And these are going to just be some off the top of my head. This is definitely not an extensive list, but the ones that are just coming to mind immediately. So just so everybody understands out there, so in the types of opportunities I invest in are typically LLCs in structure, and those LLCs have something called an operating agreement, which basically dictates terms of how the LLC is run. It's almost like the rules of how the managers have to conduct the business of the LLC. And so reading over the operating agreement is absolutely critical. It's typically a long document. It's a legal document. Some people don't like reading through long legal documents, but it's important to read it because you'd be shocked sometimes at what's in there as far as the rules. And if you don't read it carefully, you may be subject to certain rules as an investor that you had no idea about that could be really, really bad from an investor's perspective. And so I'll give some examples. So definitely one thing that's very critical is understanding the cash call provision. And what I mean by that is sometimes it's very rare, hopefully, but I don't think I've ever been through a cash call actually in 15 years. And actually, I have been, but not in real estate. And cash call is when the operator tells investors, look, we actually don't have enough money to either do this repair or to do tenant improvements for this tenant. We didn't really plan for it properly, so now we all need you to put a little money in to be able to do this, okay? That's actually a really bad scenario. You don't want to have to put money in unexpectedly, right? You want everything to have been accounted for in advance, and that's why you want a conservative operator. But let's say that happens. There are rules, cash call provisions that should be outlined in the operating agreement. So number one is if you don't find any cash call provisions in terms of like if there's a cash call, exactly what does the operator have to do, what steps do they have to do? You don't find any, I would actually walk away from that opportunity completely. That means that the operator hasn't even thought detailed enough to actually put that in there, and that's a very important clause. In the cash call provisions, what you want to look for is that you as an investor are never forced to put in more cash. The worst case scenario, if you don't put in your percentage of the cash call, would be that either they take a loan to be able to meet the cash call on your behalf, or they have to take on a new investor and you get diluted, the pro rata share. Now, one of the reasons why it's very important to look at the cash call provisions, aside from validating exactly how they work and making sure that you can never be forced to put more money in, is that I've seen some cash call provisions over the time that have been just crazy. Like I've seen provisions where if you can't meet the cash call provision within 5 days, then you get diluted by 50%, no matter whether it was $1 or $100,000 they wanted from you. So you really have to look at the cash call provisions. That's very, very important. Another really important one is the reporting requirement. So the operating agreement should stipulate how often reports have to be sent to investors, and in many cases, they'll actually stipulate what has to be at minimum included in the reporting. Now, I will be honest in saying that often the reporting provisions that are put in are very generic. They may not actually stipulate what has to be put in. Each operator will already have reports they typically put together, so it might not be outlined in here. But what you do want to see is that they're at least required to send you quarterly reports, for example, which is very typical. So that's another thing to look for. Similarly, you want to look at the distribution requirements to make sure that the rules of the LLC are such that the managers have to distribute cash every quarter, every month, whatever the amount of time frame is that's expected, which is most typical is quarterly. They have to distribute the excess available cash flow. If you don't see something like that in there, I would run for the hills, because if you're investing in a deal that's meant to provide cash flow like I do, you definitely want the rules of the operating agreement to support the fact that the manager has to distribute the cash flow on a certain regular interval. Another very important thing is called the indemnification clauses, which basically, long story short, is it describes when a manager can and cannot be held liable for their actions. And so normally what you want to look for is that often these documents, which are obviously meant to protect the managers to an extent because they're put together by the manager's attorneys, so they're going to say that a manager is identified by the company for its actions, and assuming that, let's say, there wasn't fraud, willful misconduct, or mismanagement, and there could be similar words, okay? But if you don't see the terms fraud, mismanagement, willful misconduct, general misconduct, there's a couple other similar terms attorneys like to use, you're going to want to make sure they're either in there or you may not want to participate. Because if it's not stipulated, theoretically, that means the manager cannot be held accountable if there is fraud. Now, I'm not saying you can't legally pursue them and they could go to jail, but from the perspective of them being held accountable to be reimbursed to investors, et cetera, if the rules of the operating agreement don't specifically say that they're going to be indemnified unless they've been fraudulent, then theoretically that means they can actually act fraudulently and not have any liability to investors beyond what, the general laws of the state or whatever would dictate. And so we definitely going to want to look at those provisions as well. Trying to think, there's so many different, I know I've covered a few now. There's a lot of important provisions in these. So I'll stop there, I guess, because it was a pretty long list. Yeah, those are great. But, bottom line is that, just be sure that you read these over. One last one coming to mind, very important. There are transfer provisions. In other words, there's rules that dictate how and when an investor can sell or transfer their shares. And sometimes an investor might need to transfer their shares just for estate planning purposes. While some operating agreements allow for that, some of them don't, which is very important to look for. Also, sometimes investors aren't allowed to transfer their shares at all, whereas other operating agreements allow for transfer of shares subject to a right of first refusal to buy them by either the managers or the company or other investors. And you're going to understand what that looks like, how long those rights of refusal are good for, so you can understand what it means that you have to sell your shares over. So there's a lot of stuff to look for in there, and I hope you kind of the takeaway for everybody listening is that there's so many important clauses in those agreements that you absolutely have to take the time to review the operating agreement, even if you don't like reading through legal documents. You can understand the rules that you're getting involved with. Yeah,
that's really important. I think that no one really likes reading all those legal documents, especially the 150-page plus ones. But if you read them, you can get a good sense of whether or not the operator is trying to stack the deck in their favor. And I think that's what's really critical. So of the four or five that you just mentioned there, if there's one, of course, excluding the capital call one, which is extremely important, if there's one that maybe seems like it's stacked in the operator's favor, it may be all right if the others are obviously there to protect the investor. But if the entire document just seems like they're trying to get you to fund and then you have no recourse against the sponsor no matter what, including if they commit fraud, that would be the kind of thing that you would most likely want to pass on. And in order to do that, though, you have to read them. You have to read them to get a feel for which ones are more favorable for the investor and which ones are more favorable for the sponsor. All right.
Yeah, and I do want to just point one thing out, I'm sorry, before we move on, which is, for reporting, for example, reporting very often, there may be a very generic mention reporting. Sometimes there is even a mention reporting. Yes, this operator has been operating for 20 years and they've never not sent out a quarterly report, and that's their full intention. Sometimes there's a disconnect between what the operator does and what their attorney puts in. Okay, so you also definitely want to assess whether something's missing. Was it intentional? Was it just because the attorney didn't put it in? The operator is dependable and will give you the report. Now, just keep in mind that there's a big difference between what the document says and the way a person behaves, right? And then I like to have as much in those documents as possible in the rules, so that if somebody doesn't actually send out a report in the end of the day, they can be held accountable. They've breached the operating agreement rules.
Yep.
Okay? But you can have operators, like I have operators I trust so much that even if it didn't say they had to send a report, I know they're going to, right? So the part of the purpose of the operating agreement having the right clauses in it is that you can use it as a recourse for yourself from a legal perspective, from an investor perspective, if something goes wrong. But it's not necessarily that you're worried that someone's going to actually take a certain action, if that makes sense. Just keep all of that in mind when you're trying to assess whether something's in there or not, whether it should be in there or not, and whether it was actually done, for the wrong intentions, or just done because the attorney forgot to put it in. There's something that can happen.
Makes total sense. So here's a question that I personally want to know, because everyone that reviews these opportunities, it's nice to know that you're asking questions that are sophisticated enough that the sponsor knows that you're paying close attention. So what are some of the questions that investors can ask sponsors that will make them realize that they really took the time to review the documents? They really are looking at this as a business transaction.
Boy, that's a good question. I would say, number one, that any questions you ask related to the projections that are specific questions, if you discuss the inflation assumptions, if you discuss the expense ratios, if you ask specific questions about why, let's say, what is other income? If it just says other income, what is that? What's in there, and why did you assume there's going to be other income, for example? Just asking that one question alone, which seems pretty straightforward, is definitely sending the message to the operator that you've read every single line of the pro forma, right? So definitely getting any questions that are very specific with regards to the pro forma are going to tell the operator that you've definitely been paying attention. Another important one, which we didn't address today, which is very, very important, is background checks. So I always conduct background checks, and in fact, every time I invest with an operator, I redo the background check just to make sure nothing's changed since the last time, right? Because someone could, at some point, everybody wasn't a criminal, right? And then anyone who's, at some point, some people become criminals, some people are never criminals. But at some point, nobody was a criminal. When they're 3 years old, no one is a criminal. So, so it's important to constantly recheck those, right? And but background checks in general, the one thing that I find that passive investors do the least and should do the most. Meaning that it's very rare that I talk to somebody and find out they've run a background check on somebody, but I find it to be one of the most critical things to do. That is, that can be done and that should be done before making an investment decision. And I mention that in relation to your question because asking for someone's background check information, which in the way that I run my background checks, I normally have to have, I ask for a home address and a date of birth. I don't need anything else, and then I can match them for sure that I got the right person when I'm trying to find them to do a check on them. When you ask for someone's home address and date of birth, they know you're serious, right? They know that obviously you're going to run a check. That means they're serious. You're serious. And if you're going to get to the point of running a background check, and you're going to be the majority of people who run a background check, they know you're very serious. So that's another important thing, but also sends a really good message to the operator. Those are just a couple quick ones coming to mind.
Yeah, those are great. Those are great. Absolutely. Especially when it comes to reviewing the pro forma, asking questions about the pro forma are definitely indicative of someone that spent the time to review the documents. So in your investment career, what is something that you wish you'd done differently or something that you wish you had learned earlier, something like that?
Great question. I would say from a high level, two really critical things. And, this is going to sound, I'm forgetting the term is, I'm just losing, I can't remember the term, but essentially you've heard this before, which is, starting younger is always better, right? So start is to invest. I don't care if it's in cash flow. I don't care if it's stocks, whatever it is. Fact of the matter is the sooner you begin to invest, the larger your potential compounding effect could be over time. And I think that's really critical. I would have loved to have started down my cash flow path even earlier than I did. I actually don't remember the exact year it was. I'd have to go back, but I think it was probably when I was 28 roughly. And if I could have started 10 years before, I'd be in an even better place now, right? And I think everybody would probably say that of their investing career. So if you're listening to this, you haven't started investing in anything yet, I'd say even if it's as simple as going into a stock index, just make it simple to start. Whatever it is, the sooner you get investing, the better off you're going to be in the long term. So that's number one, on average. Number two is I really wish I understood the power of passive cash flow earlier on, meaning that I got lucky. I ended up on the cash flow path, and it completely changed my life. It's gotten me out of the corporate world. It's given me complete freedom to do what I want with my days. And it's just, I work from home. My kids come home at 3. I don't spend that much time with them between 3 and 6. I see them at 6 for dinner every night. But I actually work in the living room, and I talk to them a little bit while I'm working, and I'm there, and they're there at the same time. And I'm very lucky to be in that position. And, cash flow enabled that for me. And it's funny because I think that Main Street and Wall Street are both so used to investing in stock. And I think there's a ton of marketing surrounding like getting people to invest in their 401k in stocks and just have this like stock and bond mentality. I think that the majority of the population is completely missing the boat on cash flow. And it's amazing how that can just change your life. And I think it's unfortunate that the majority of marketing money goes towards compelling people to invest in stocks and bonds, but it is what it is. And there's great aspects of stocks and bonds too. But I wish I understood the power of cash flow earlier. I wish I had researched it earlier, come across it earlier, invested in it earlier, because it would have changed my life even earlier on.
Yeah, I completely agree. I mean, I think that's a great answer. I think, especially when you talk about the marketing, most people that when they think about their financial goals, they usually have to do with passive cash flow. And then the problem is almost none of their investments are actually set up to get passive cash flow. Like people think of retirement as generally being able to pay off their monthly expenses without working. And then they proceed to invest in a blue chip stock that has a 1.2% dividend. And it's because of marketing. It's because they haven't thought it through clearly enough generally. So yeah, I completely agree with that. As far as the future is concerned, what are you most excited about for the future of your career?
Well, to be honest, it's been about 15 years that I'm investing in passive cash flow now. And what I'm most excited about is that, taking a passive cash flow approach is a very slow and steady approach. Okay. You're not going to get rich quick overnight. That's not the point of it. But the longer you go on, the better off you're going to be. It's like a slowly growing snowball. And what I'm very excited about now is that 15 years in, I'm starting to get to a really good place from a passive cash flow perspective. I kind of see the writing on the wall, and 10 years from now, I'm going to be in an even better place. And all these many, many years, it'll be like a couple of decades at that point, will have proven themselves out to be worth all the effort, because I see the writing on the wall with, as long as I continue to reinvest and focus very keenly on it, I'm going to get to where I want to be. And so for me personally, it's just being in the position I'm in now after 15 years, having put the time into it, it just makes a big difference. And I would say, there's probably a lot of people listening who maybe never invested in cash flow before, maybe a couple investments in cash flow, and maybe want to go down the path. And really, in the end of the day, it's just a matter of time. Like time, if you have time, you will be able to figure out how to do this. I would say that to anybody. It's not that complicated, especially investing passively where you're making bets on other people, because you don't have to learn how to operate a building. You don't have to learn how to, fix the toilet. You don't have to learn what price a self-storage unit at for somebody. You have to learn how to make bets on other people, how to assess other people, and then let them do the work. And it's amazing when you start leveraging people in those ways, how the cash flow can accumulate over the years and can really change your life. And so I would say that, anybody can do it if they're willing to be really patient. And patience is the absolute key. But please believe me, if you're listening out there, it is so worth it. It's just amazing how cash flow changes your life if you have the patience to really build it up.
Awesome. Well, I think that's a great note to end it on. Jeremy, I really appreciate you taking the time for this call. And I just want to mention, when you mentioned, I wish I had learned more about passive cash flow earlier. I definitely want to thank you, because you definitely helped teach me a lot about passive cash flow, and I'll probably be reaping the benefits of that for many decades to come. So thank you again, and I really appreciate it. For all the listeners out there, thanks a lot for taking the time to listen to this today. If you have any questions or feedback, please contact me at Hunter Thompson at cashflowconnections.com. That's Hunter Thompson, THOMPSON at cashflowconnections.com. And I look forward to investing with you. Thanks a lot.